Okay, so let's get right into it. There's a lot of chatter right now from very different corners of the financial world, but they're all basically saying the same thing. A major economic crisis is coming. In this breakdown, we're going to decode their arguments and see why they believe the system is flashing so many warning signs. And yeah, these warnings are pretty intense. We're talking about predictions of a downturn that could be more severe than the Great Depression and the 2008 financial crisis put together. So what on earth is driving a forecast like that? Well, it all boils down to three core signals that these analysts see converging. The first signal, according to analyst Stephen Van Meter, is coming from the U.S. job market. He's pointing to some really specific cracks that are starting to show. Cracks, he says, are identical to the ones that appeared just before the dot-com bust and the 2008 meltdown. For him, this is the first domino. Now, the second viewpoint from EconoSilicon kind of zooms out. They argue this isn't just about jobs. It's a much deeper structural problem. We're talking about households, banks, and even the government itself, all being buried in debt simultaneously. That creates a kind of system-wide fragility that we really haven't seen before. And that brings us to the third signal, which Peter Schiff says takes this whole thing global. He argues the real issue is a crisis of confidence in U.S. government debt. And if the world loses faith in U.S. debt, it means they're losing faith in the U.S. dollar itself, which has always been the planet's safe haven when things go wrong. So let's start with signal number one, the job market. According to these sources, the very first tremors of a big economic earthquake are being felt right now, and they're hidden inside the jobs data. In January, announced job cuts shot up by 118% compared to the year before. Now, a number like that sounds abstract, but think about it this way. For every 100 people laid off last January, 218 were laid off this January. And the really wild part? That's the highest number for a January since 2009, when we were right in the thick of the financial crisis. And it's not just about firing people. Companies are also slamming the brakes on hiring. This chart right here shows that plans to hire new workers just hit the lowest level ever recorded, and they started tracking this back in 2009. So not only are more people losing their jobs, but the opportunities to find a new one are disappearing right behind them. And this slide really puts it all together. It's not just one bad number. Initial claims for unemployment are ticking up. Continuing claims, which means people are staying unemployed for longer, are surging. The number of actual job openings is shrinking. And the next step in this whole sequence, that's expected to be companies cutting the hours of the employees they have left. So why is a weakening job market such a huge deal right now? Well, that leads us directly into our second signal. This is all happening inside an economic system that's already stretched to its breaking point, a system that is just dangerously overloaded with debt. And this story starts at home. The average American is carrying more than $15,000 in personal debt. And according to one analysis, for a lot of people, this isn't good debt for investments anymore. This is debt just to cover the basics. It's debt for survival. And you can see how it's all stacked up here. Mortgages are obviously the big piece. But look closer. Credit card debt is exploding, with interest rates hitting an insane 22 to 28%, often for things like food and gas. And see that little slice for home equity lines of credit? It's up over 7%. That means people are literally pulling cash out of the walls of their houses just to stay afloat. Okay, now let's zoom out, way out. From the family budget to the federal budget, the U.S. national debt is now more than $38 trillion. That same financial fragility we just saw in households, it's being mirrored at a national level, just with a mind-blowing number of zeros attached. And here's why that matters so much. Look at this comparison. Back in 2008, the government's debt was about 67% of the entire economy's output. That gave them the power to step in and be the rescuer. Today, that number has almost doubled to 125%. So the argument is that the very entity that bailed everyone out last time is now one of the biggest sources of instability in the system. The rescuer has become the risk. And that massive government debt brings us to the third and final signal, the one that takes this whole problem global. The argument here is that the ultimate safety net, the US dollar and US bonds, aren't being seen as a guaranteed safe place to hide anymore. This slide is so important because it shows the critical difference. In 2008, the problem was private debt, bad mortgages. The government stepped in to fix it, and in all that chaos, investors from around the world fled to the US dollar, making it even stronger. But this predicted crisis is the total opposite. The problem is seen as sovereign debt, the government's own IOUs. And if the US government is the problem, well, there's no one bigger to bail it out. The expected result? The dollar gets weaker, not stronger. And this isn't just a theory. There are signs it's already starting to happen. Peter Schiff points out that foreign central banks, some of the biggest buyers of U.S. debt, are now buying gold at record rates. He argues this is a huge red flag that the world is quietly trying to find an exit ramp from the U.S. dollar, losing confidence in its long-term stability. And this quote just says it all, doesn't it? In every past crisis, when things got scary in the private sector, money would rush to the safety of government bonds. But if the government itself is seen as the epicenter of the crisis, that entire safety mechanism just vanishes. So, you've got these three huge, distinct warnings. How does it all fit together? Well, the real alarm bell these analysts are ringing isn't about any one of these things happening in isolation. It's about all three of them converging at the exact same time, creating what they call a perfect storm.
And here's how they see that cascade playing out. Step 1, the job market breaks, which cuts off incomes. Step 2, that loss of income hits a system that's already drowning in debt, from families all the way up to the government, causing it to crack. And then step 3, when everyone looks for a safe place to hide, the traditional safe havens, the dollar and US bonds, are no longer safe, which just throws gasoline on the fire.
So, that's the bottom line. It is the powerful, toxic combination of a weakening job market, a system saturated with debt, and a global reserve currency that's starting to stumble. That together create a crisis that has no obvious, painless way out. And that really leaves us with a fundamental question these analyses pose. In every past crisis, there was always some kind of escape hatch, a financial backstop. But if the job market, the debt system, and the world's safe haven currency are all flashing red at once, where does the system turn?